Welcome to another episode of Smokin Bulls, the podcast about business, money, and lifestyle. I'm Tyler.
I'm Dave.
And today we're joined by Peter Bowen of Fidelity Investments. He's the VP of Tax and Retirement Research, and he's here to discuss the 2023 federal budget with us. So let's get into it. Peter, thank you very much for joining us. This is, I think, your second time here on Smokin Bulls, if I remember right. Last year, 2022, we did a budget sit down with you. So thanks for joining us again.
Well, thanks for having me on again.
You bet.
Great. Yeah.
So maybe you could tell us, I guess, a little bit about yourself so our viewers know exactly who you are with Fidelity, a little bit maybe about your background, and then we can kind of dive into some of the relevant topics that you found in the 2023 budget.
Certainly. So my title is VP of Tax and Retirement Research. So those are the two areas that I focus on, and I help financial advisors and their clients deal with tax issues, retirement issues, and estate planning issues, and keep an eye on things like the federal budget as these rule changes come out from these budgets. My background is I've been with Fidelity since 1994, so that explains some of the gray hair, I think.
That's your background.
I'm a chartered accountant. I was with the tax group of PricewaterhouseCoopers for 6 years prior to that. And at Fidelity, I've only had two jobs. I was the treasurer for the funds for many, many years until 2012 when I transitioned into this role, so that's over 10 years now in this particular role. And I'm a keen cyclist, as you might be able to tell by the picture in the background. That's my passion.
Right on. Well, I think, Dave and I, of course, have read a little bit about the budget that was dropped here for 2023. Not a lot of big changes to it. And we talked briefly before this podcast went live. But maybe you can kind of touch on some of the highlights that you've seen there, the stuff that's affecting people in your realm and people, I guess, in ours as well. We're quite often focused on a business owner in our business plan, in our wealth management side of the business. There was some tweaks in the budget that do affect these people. So maybe you can touch on a few of those topics and others that you saw that were of interest. Absolutely.
So I do get the good fortune, although you might disagree with that term, of going into the federal budget lockup. So on budget date, I go to Ottawa. I go into a room where I can't be on my phone. I can't use my phone or internet for 5 hours. So I'm in a room full of tax accountants and tax lawyers reviewing the budget materials. And it's very exciting. Well, okay, maybe not. And it does give us an advanced look at the rule changes. So it's really good to focus in and see what's there that affect financial advisors, taxpayers, individuals, and small businesses, of course. The good news is that this year there weren't a lot of substantive changes, to be honest. Couple big areas for small businesses, which we will get to, but they didn't raise tax rates in general, other than peripherally through what's called the alternative minimum tax. They didn't increase the capital gains inclusion rate, right? That's been bandied around as something that's been speculated about for a number of years. So right now it's 50%. So if we sell something, 50% of that gain goes on our tax returns. It's been speculated that will be increased, in particular because the Liberals are supported by the NDP, who were explicit in their election platform that they wanted to see that increased to 75%. But I think as investors, it's a great thing that didn't change. And there were also no changes to a couple of the tax structures that we utilize in the investment funds industry, such as what's called corporate class and T-series or return of capital strategies, which we can talk about later if time permits. So in terms of what was there, I mean, the headline related to a lot of increased spending, a lot of increased deficits, and the grocery rebate, right, which is meant to help low and perhaps into the middle income bracket Canadians. It's just an increased GST credit. Nothing to do with groceries, right? That's a marketing term, the grocery rebate. You don't have to buy groceries or spend it on groceries to get this. It's just based on your income, and couples with two children can receive up to $467 as a result of this so-called grocery rebate. In terms of that alternative minimum tax that I mentioned, so under the Canadian tax system, we actually have two separate calculations, right? It's the regular one that we're all used to, that, well, we do our tax return. It tells us how much tax we owe. But actually, there's a second regime called the alternative minimum tax. It's meant to go after high income earners who take, shall we say, undue advantage of tax preferences. And tax preferences are anything from the capital gains inclusion rate to interest deductions, for instance. And it really only affects high income individuals. But this current government has been, harping at the, hey, we want to make sure the wealthy Canadians are paying their fair share. So they've really ramped up the alternative minimum tax. And they expect this to raise over $3 billion over the next 5 years, in fact. So it's a fair bit of taxes. I'll believe it when I see it. So what are they doing there? Well, under the alternative minimum tax regime, you sort of start with your existing tax structure, but then you make a few changes. For instance, capital gains, instead of 50% of them being included in income, it's 80%. Under the new rules, that's going to go up to 100%. Okay? And for instance, you deduct interest if you borrow a significant amount of money to make an investment, and that investment's intended to provide income at some point in the future, you can deduct the interest. Well, under the alternative minimum tax regime, that still worked until these changes, at which point only half of that interest will be deductible. So actually, some small business owners could be affected by that, right? Yeah. Many of them borrow, they need to put a capital into their business. If they do that at the personal level, they're only going to get 50% of that deduction going forward. So it's something to keep in mind. The other elements of it is that there's an exemption on the first $40,000 worth of income. That's actually going to bump up quite significantly to $170,000. But perhaps the other biggest change on this is the rate. So our top federal marginal tax rate, so that's the tax rate that applies to the next dollar we earn, is 33%. Under the alternative minimum tax regime, it was 15%. It's going to 20.5%. So they do expect to catch more people. Now, the reality is very few people will get caught by this. It's got to be high income people taking advantage of these tax preferences, as I called them. And the other thing we have to keep in mind is that anytime we have tax changes, we also have to think about behavioral changes. Right? Because if you're a high income person that's going to be affected by this tax, you might change how you do things. Right? Maybe you do it through a corporation and boom, corporations aren't subject to it. Hey, we're off to the races. So I'm not convinced they'll raise over $3 billion in taxes.
That'll be our measuring stick to look at in 5 years.
Yes, exactly. Although I'm not sure you'll get the data to really tell you if that's happened. It's probably.
And how good is our memory 5 years from now? Are we really going to go back? And, what did they say 5 years ago? Yeah,
I have no idea. We'll have this record, won't we? Another substantial change that can affect businesses that are doing more aggressive tax planning is there's something called the General Anti-Avoidance Rule, or GAR. It's a big sledgehammer that CRA has if it disagrees with how you're applying the tax law. Right? You're doing an aggressive tax strategy that technically is on side with the Tax Act, but maybe it's outside what the Tax Act intended. They can use GAR. Well, CRA uses GAR, once in a while. Like I said, it's a big sledgehammer, but they've lost some court cases over using GAR. Now, if you and I lose a court case to CRA, oh well, c'est la vie, right? We pay our taxes and move on. CRA loses a court case. What can they do? Change the rules, right?
Change the rules. Yeah.
So that's what they're doing here. They are changing this general anti-avoidance rule to make it more favorable to them. From a real world implication to that, I think anytime you're getting presented with something that sounds perhaps a bit too good to be true, you want to be even more careful now to make sure you understand the tax risks, because it's not just, hey, this meets the technical letter of the law. CRA can still come in and say, going to assess you on a different basis because of this enhanced general anti-avoidance rule. So, anytime we're talking about something that provides tax advantages, and it's make sure we understand the risks. That's just become even more important than ever. What else? There were some tax changes that affect large corporations, public corporations, right? There's a new 2% tax on share buybacks. So for whatever reason, the federal government's a bit offended by the fact that companies are buying back their stock instead of paying dividends, perhaps, or instead of keeping the money within the corporation. So they've decided they're going to apply this 2% tax. I'm not sure it's really good policy, as opposed to, it makes a good headline. And headlines are important when it comes to, analyzing budget items, right? So, sure. The other area only affects financial institutions. Right now, dividends aren't taxed if they're received by financial institutions, Canadian dividends, if they're on sort of portfolio holdings. That's by design. That's meant that's how the tax system is designed to work, to avoid double taxation. But for financial institutions only, they're taking away that feature and making them taxable. So again, this is a second budget in a row where they've really gone after financial institutions such as banks and insurance companies to make them pay more and more taxes. Of course, who does that affect? Well, everybody owns shares of banks and insurance companies, right? So that reduced return impacts all of us, whether it's through our RSP or TFSA or non-registered accounts, whether those are personal accounts or business accounts, right? Yeah. So, all right, let's move on and talk. I think the final area I'll touch on is those areas that affect small businesses. So there are two changes. First, and they're both, I have to say, highly technical. The first one is relates to what we call intergenerational business transfers. That is, you've got a small business and you're passing it on to the next generation. Well, there are a slew of rules to try and make sure that's done in a tax efficient manner, but only if it's done legitimately. And there were some changes introduced, stretching my memory here, but for 2017, you may recall there were three major subheadings of changes that affected small businesses, which angered small business owners quite considerably, understandably, right? So the government did back off on those a lot, including on these business transfer rules that they tried to really tighten up, probably overly so. Then last year, there were some changes made through a private member's bill, which is unusual, but that did go through. The government didn't like some aspects of that. So as part of this federal budget, they are introducing additional safeguards to ensure that only genuine transfers benefit from these rules. Again, highly technical rules. The tax community is still mulling them over, trying to figure them out. If you are looking at transferring shares to the next generation at any time in the next decade, I'd wait a little bit to let the tax community digest the rules, and then it's a question for your own tax advisor. But there is another change in the federal budget, and that is the introduction of what are called employee ownership trusts. And this gives another option in terms of how one gets rid of is a bad way to put it, isn't it? Sells one's business, right? Transitions out of the business. So we can transfer it to the next generation. We can sell it to third parties. Well, the employee ownership trust, as it suggests, is meant to facilitate share transfers to employees. Right. So it's an alternative succession plan available to business owners. And there are a number of tax changes in this federal budget that facilitate that. Now, again, just like the intergenerational business transfers, these rules are highly, highly complex and will take time to digest and will probably change over the next year or two in any event. So stay tuned, speak to your own tax advisor if it's something that might affect you if you're a business owner. So I've rambled on a fair bit there on the budget. Tyler and Dave, what questions might you have?
Well, no, that was very good, Peter. I had a list of topics I wanted you to touch on, and you went into that list and checked them off in order. So I don't know if you got my list beforehand or what, but you checked off all my boxes here. The last one that you were talking about, which you of course mentioned, is going to require some debates and conversation with your own personal tax advisor, but the business transfer to employees and that ability to transfer shares, is that transferring shares? They're transferring shares directly to their employee then as an ownership change. Maybe a little bit about the benefit of doing that. What an owner would have. What's the benefit of being able to do that? Are they doing that in a tax preferred way because the shares are moving over to the new owners and they aren't then therefore triggering a tax disposition, or what's happening there?
They do trigger taxes, but we may be able to take advantage of the lifetime capital gains exemption. That is a nice benefit that small business owners have, where they can sell shares worth up to, I think the number for 2023 is $971,000 of capital gains without paying any tax on that. It goes up with inflation, and it will hit $1 million very soon. And that $1 million mark, by the way, is important because farmers and fishers have a $1 million amount that doesn't go up by inflation until the other limit catches up. Again,
I see.
Complexity, right? Like just,
yeah.
Really, why do we have to build all this complexity into the Tax Act? By the way,
accountants continue to have jobs. The accountants I know say as long as they keep changing the Tax Act, they'll always have work.
That's right. So by the way, that alternative minimum tax can also trip us up there. 30% of any gains actually go into the alternative minimum tax calculation. So even though you may, if you triggered exactly a $971,000 capital gain, it would be tax-free. The alternative minimum tax might catch you up. In fact, likely would in many scenarios. But the shares aren't being sold to the employees themselves. They go into a trust. So that's point one. Point two, though, is that it's funded by the company itself. And with these loan facilities, it's possible to spread the capital gain on that disposition out over as long as 10 years.
Oh, okay.
So, a number of benefits there. Very, very complicated. All the I's have to be dotted and the T's crossed to really make this work.
Right on. I also like that the 50% capital gains exemption didn't change.
Yeah.
That worries me every year. It's one of the first things I look for is, did they change it?
Yeah. So I'll jump backwards for a quick sec, though. I assume anybody with a corporate tax structure with their operating company's shares held by their holdco, they sell their company to an employee ownership trust. There is no benefit still for them in that situation.
For the lifetime capital gains exemption, that's true, because a holdco doesn't get that. That's why we often see structures with the holdco out to the side and the shares continuing to be owned by an individual, so that when the individual sells the shares of the company, they can indeed get that lifetime capital gains exemption. Corporate structures get complicated. We have family trusts and holdcos off to the side, and the holdco owned by the family trust.
Yeah.
Those are all for those reasons of trying to maximize those tax benefits.
Okay. Okay. So I guess we can jump back to the capital gains. The 50% hasn't been changed. I think every time there's a budget, there's always speculation it's going to happen this time. It's going to happen this time. I can't see how they're not going to touch it at some point. I mean, that's kind of, it looks good because everybody just thinks anybody who's, if anybody's got a capital gain, they have money, therefore they should pay.
Right. And they, statistically, they can show that. But that's sometimes a bit misleading, right? So you might have someone making $80,000 a year. And in a particular year, they sell a cottage or camp, whatever you want to call it, or a chalet perhaps, and they have a $300,000 or $500,000 capital gain. Well, half of that goes into their income. For that 1 year, they're a high income earner, aren't they? So when you look at who's taking advantage of the capital gains inclusion rate, it's high income earners. But then the next year they go back to making $80,000 a year. They're really not a high income earner. And yet the statistics would say that they are. So it's a bit misleading. And as you note, this government has a penchant for going after the high income earners, make sure they pay their fair share. We've seen that on a number of fronts, even if it's mostly window dressing like this alternative minimum tax, I think, which will affect some people, but not nearly as many as anticipated. And every year we have this speculation about the capital gains inclusion rate. Sometimes people will pour through their portfolio, look for things that are in a gain position that they don't want to hold for too much longer, sell it before a budget to make sure they capture the 50% inclusion rate just in case it gets increased.
Yeah, I think that's, we've been working that for years, just thinking, okay, do you want to bite the bullet? And, and when it comes to portfolio management, I mean, you can only ride one portfolio for so long, and then you've got a large gain. And then you're
absolutely
out of sync with the world. And so it's okay. Do you want the portfolio changed, or do you want to not pay the tax? And so clients have a choice. Obviously, we really hesitate to recommend making a move because the inclusion rate's going to change. Like, that's a scary one to advise on.
It is.
It's come up all the time in discussion, and it's relevant. I mean, even on, not even just selling your cottage or your cabin or your camp. I mean, death. All of a sudden, that could be a huge one now. We can
absolutely
stuff we can't control when we die, but how do you do that? Do you trigger off your capital gains now because of that? Like, these are tough things, and the uncertainty of it is not really good for it. I mean, if you think about it, it's kind of like the Fed. If they just talk tough, it can have an impact on the way people's behaviors are. So if our government keeps talking or hinting that maybe they'll do the capital gains, well, I'll go trigger them. They'll get their tax money anyways.
That's right. Maybe they're playing with our minds.
They're toying with us. I would.
Toying with us.
I don't know if any government is that smart, but I'm sure there's a lot of people employed there that have a whole list of things they could do. So They obviously think about this stuff on a regular basis. So,
yeah.
Well, I think that's my questions have been checked off. Or
I guess I'm going to jump over to AMT then. Basically, you said obviously it's complex. And, as advisors, we're always strategizing with tax advisors and so on to find ways to kind of skip around these. And so I guess it ties into the general anti-avoidance rules as well. But, there's a lot of maneuvering with insurance and things of that nature. Can you see some of these insurance maneuvers? I guess, they kind of dodge AMT, except for when people are using their insurance policy to borrow money against to invest. That
exactly
is going to catch up there, I guess, on the amount of
exactly. That's the one area where I think the insurance industry has concerns about how this could impact investors. Is that borrowing, right? So instead of getting a full deduction, now you only get a 50% deduction. That's a big change. But again, it has to be pretty big dollars for it to matter.
Yeah.
So that's where it's almost like going into these things. People will need to speak to their own tax advisors and say, hey, by the way, if this change had been in place for 2022, so once we get through April, we've done our tax return. If this change had existed then, would I have had an AMT problem? That's a good way to look at it, to plan ahead and say, if the answer is yes, well, maybe you want to change how things are structured. We always want to be careful about letting the tax tail wag the investment dog, shall we call it? But there might be simple ways to rearrange things so that one is not caught by the alternative minimum tax. And I don't think GAR should come into play with most of those structures, although you'll never say never, right? So the more aggressive structures could be susceptible to the general anti-avoidance rule. That will remain to be seen. So
yeah, I think as you say, as they tighten them up, it's a concern for us when we look at using. I would say on the investment front, it's locked down. There's not a whole lot you can do on the investment front. Investing in securities and things of that nature. I guess if you're moving properties and companies and corporate type stuff, you could run afoul, I would think, of that. But I mean, maybe on the insurance front, I guess is where I'd be more concerned. You're buying a policy, you're overfunding a policy, you're borrowing personally against that policy, and how many moves do you make before you start getting that's a lot of shuffling around to get this.
Well, exactly. And if you end up with a year where you have a big interest deduction from that type of strategy and a capital gain, right, you could end up with that double whammy that throws you into the AMT. That's one of those possibilities that you have to keep in mind. On the investment front, there are strategies out there that are perhaps overly aggressive, and people do need to be cautious. I mean, mainstream, investment companies like Fidelity Investments, we're not doing those aggressive strategies, but there are smaller companies where they do have some more aggressive strategies that I think are more susceptible to that general anti-avoidance rule. So even in the investment world, there can be situations where the general anti-avoidance rule, or GAR, could kick in. So keep an eye out. There was one other item, by the way, in the budget, and this is just as someone who has to read all the materials, there's a lot of filler, right? So here's one other item that's in there. Budget 2023 announces, which is ludicrous because this is an old thing, not old, but older, announces that financial institutions will be able to start offering the tax-free first home savings account to Canadians as of April 1, 2023. So as of April 1, well, we're past that. I think that's a bit of an April Fool's joke by the government, because April 1 was a Saturday. But the reality is financial institutions aren't ready to offer those new tax-free first home savings account yet. Very close. At Fidelity, we're really hoping this month, at least spring. Others are at different stages of getting these accounts up and running. But that's, again, putting in the budget 2023, really, it was announced a year ago.
Yeah.
Right? So, and all the legislation actually came out last November. It's a pretty powerful new account.
Yeah. But
it's not new as of this budget.
Not new for the budget.
Yes.
Maybe let's just talk a little bit about this new plan. I guess, the terms of it are, fairly straightforward. I mean, as I like to describe it, it's like putting money into an RSP, but that doesn't affect your limit. You get a tax contribution or a tax deduction for your contribution. When you take it out to buy a home, it's like a TFSA. You don't owe any tax on the growth.
Exactly. It's the best of both worlds.
Yeah.
Right. It's a hybrid account. It's the best of both worlds. Honestly, it's very powerful. But if you own your own home, you're not eligible to open it.
Not for you. Yeah.
But, like I think about myself, I own my own home and I can't use one of these, but I do have a 24-year-old who does not own his own home. So it's a great way for parents to help the next generation towards the cost of a new home.
Yeah. And
by the way, you mentioned, yes, it's pretty straightforward, but the devil is in the details. There's a lot of complexities of these counts when you dig into it. It's like 20 pages of new legislation, which, again, why are they making it so complicated? Why didn't they just tweak the home buyer's plan, right? It's an existing program allowing people to take money out of an RSP for the purposes of purchasing a home, only it has to be repaid over 15 years. Well, why not just tweak the home buyer's plan and say, hey, that's tax-free. And instead of 35,000, make it 40,000 or 50,000. Boom, we're done. Instead, we've added a tremendous amount of complexity to that.
Well, depending on where you live, it's going to be, you'll need your first time savings plan, home savings plan, plus the home buyer's plan to be able to even get there still. Like
that is absolutely true, but they could have just increased the limits on the home buyers plan without adding all this extra complexity. But hey, we always have to remember with tax changes again, right? It's policy and it's politics.
Yeah, that's why they both start with the same word. Question. I mean, this is just out of the blue, just came to my mind, but do you think this is something that will be allowable under a group type plan? You know how you have a group RSP. Do you think there'll be a group first time home savers plan?
It's possible. I'm not sure. The challenge is there's a lot of effort that goes into building these accounts, and then to layer it into a group policy for a relatively small proportion of a company's employees, for instance, may not be worth the efforts there. Whereas people can open it separately on their own anyways. One advantage of it being a group plan would be maybe you could make monthly contributions that, on which you're not taxed, rather than waiting till you file your tax return in April, right? So it could provide some advantages there. And by the way, even for people who don't plan to own a home, may never own a home, this account could be beneficial if they, again, qualify to open one. It's like getting an extra $40,000 of RSP room, because at the end of this account's life, which is a 15-year life, that money can be transferred over to your RSP. Doesn't use up RSP contribution room.
Yeah.
Doesn't require RSP contribution room. So I think that's a relatively small proportion of the population that will be able to take advantage of that. But for those people, it's a great new tool. It's not how I would have designed it, but it almost feels, does feel like a loophole to me.
Yeah,
but that's how it works. I do think most people will use it for its intended purpose, though.
Yeah. Well, I mean, I guess you could always sell your house to your kid and move out and buy it back from them 5 years from now and save up under your home savers plan.
This is how the tax act is written. It gets really complicated when you start thinking like that.
That's how I like to think of it, though. So that's how I like to think of it, though. So
I get lots of questions about it.
Yeah.
How can I work my angle here?
I'm going to throw another one that wasn't in the budget, but there was a change. Probably, I think, earlier from last year on flow-throughs. In the sense that they are kind of really pushing this rare mineral mining that it gets you an additional 30% or something like that. How does that work, or are you familiar with this change?
Yeah, again, that's one of those very technical ones. I'm not familiar with the nuances of it. I think it is 30%. And I should mention, by the way, there were other similar things happening. I think there's a flow through for one of the clean technology segments. Actually, there's a whole section of this year's budget about green energy or clean technology. I think they add, clean in front of something, and suddenly there's an investment tax credit available, or at least in one case there, I believe there's a flow through for it. There will be opportunities there for sure, as I guess the investment bankers and tax accountants and lawyers get into the details to offer these flow through type of shares to investors. So that will be coming, but the details are beyond my expertise, to be honest.
Nice. Okay. Well, I appreciate that. Thanks. I know we hadn't prepped you we're going to throw you a flow through question, but yeah, that's great. Thanks for that. What do you got there?
I'm good, Peter. I think you've touched on more than enough for what we want to cover today. I think we probably have to set a date for next year if you're still around at Fidelity for 2024's budget, because now we're making this an annual thing. So
absolutely. Always a pleasure to talk to you. And we'll cross our fingers that they don't change things too much for us, right? Like the corporate class and T-series and capital gains inclusion rate. Usually when a budget's interesting, it's bad for taxpayers and for those of us on this call.
That's true. It's a pretty quiet budget this year. And like you say, that's not a bad thing. So thank you again for being here, Peter. We really appreciate your support of Dave and I in our wealth management practice. And thanks for sharing your insights about the budget this year. We do appreciate it.
My pleasure.
All right. Well, thanks everybody for watching this episode of Smokin Bulls. If you want to learn more about us, you can follow us on social media or head over to our website at towerwealth.com. Thanks for watching.